Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so last workshop for the semester. The workshops are designed to help you with the assignment, and with our second assignment being easy is the wrong word, shorter, I think is the right word, shorter than the first assignment, a lot shorter than the first assignment. The need for workshops doesn't exist beyond this workshop for today. So no more Thursdays. This is the last Thursday. It's just going to be Monday lectures, which are still important, of course. I'm going to ask you questions in the final exam from those lecture notes as well, but this is the last workshop. There's no workshop for like end of semester for like practice or anything. I do that in the lecture. So yeah, this is the last workshop. So let's make use of it. I think we might have a public holiday on Monday, right? If we have a public holiday on Monday, I don't think they send me the alternative venue for the makeup lecture, but I'll post that on Waddle. I'll post it on Waddle, and of course I'll record it. So for those who cannot make it, no big deal. But it's always nicer to make the lecture rights more interactive. If you have a question to ask, you can. But if you don't have any, if you're not the kind of student who likes asking questions, that's fine. Doesn't bother me. So today is all about assignment number 2. Assignment number 2, just because I said it's easier is, I don't like the term easy or hard because it's very subjective. Let's just say it's shorter. Just because it's shorter than assignment number 1 doesn't mean that you should take it for granted. Right? It's still 15%. It's you want those marks, right? So please take it seriously, and I'll go through the difficult. I already mentioned in the lecture what parts of the assignment can be require more of your time, and I'll highlight that again today. So, as I said in both the lectures and also the assignment guidelines, remember to read the assignment guidelines as well. They're not there just to be annoying. They're there to be consumed by you. So this is the marking sheet that you would have gotten back for assignment number 1 as a team, and you also get one for assignment number 2 that looks like this. So please have a look. This is what I'll be looking for when I mark. And some notes on assignment number 2 are here, of course. Yeah, so have a read. As it says there, all the different valuation ratios. I'll say again, it says that in workshop, PE and EVM or enterprise value are mandatory. The other ones that you could look at for JB Hi-Fi is cash flow multiples okay, price to book is okay, price to sales is it's an outdated approach. We're not in the 50s, right? So dividend yield, you can calculate that, but it gives you a percentage. Some of the parts is not relevant to JB Hi-Fi. Takeover valuation, not really relevant to JB Hi-Fi. You can if you want to, but what I would do if I was you, I would focus on, PE, cash flow, EVM, dividend yield, okay, it's an easy ranking, and price to book, and that's about it. And I'll talk about composite valuation today. So definitely have a read of that as well, please. Some of you didn't. The reason why I highlight that is it was obvious some of you didn't read that for assignment number 1. Yeah. So let's have a look at this assignment number 2 business. As I said, the requirement, if you don't do this, you will fail. Very plainly. I'll put it as plainly as I can. You will not do well in the second assignment if you do not do a PE and an EVM or EBIT multiple valuation. Don't do both. Don't do both EVM and EBIT. There's no additional marks for that, so you don't waste your time. They're equivalent. It's just some analysts like EBIT multiple, some like EVM. I was always an EVM person, but whatever. They're both based on the same way. It's just a little definition on whether you do the depreciation amortization or not. For JB Hi-Fi, it doesn't matter because depreciation and amortization for a retailer is quite fixed, quite flat. It doesn't fluctuate a lot. So P and EVM is what I'll be looking for at the very minimum. At the very minimum. But as I said, and it says here in the guidelines, there are more ratios that you should do. If you just do those two, and you do them well, and no mistakes, you'll probably get a distinction in the assignment, something like that. So I expect you to do more. So as I said, cash flow multiple, dividend yield, and price to book is definitely something that you should look at. Now, once you have all these different valuations, how do analysts sort of summarize them? That's what this composite valuation is all about. In the lecture, I didn't really have time because I was just so far behind in that week. But if you go to the example from week 6 of all things, and you go to the very end, you'll get a very crude, what's this composite valuation tab, right? This is actually not very good. This is from a team. I want something better than that. And what I will be looking for, what analysts do to bring all these different ratios and DCF, all the different ways you can value a company you're valuing together, is through a composite valuation table that looks something like this. Right? This is a composite valuation table for an example here. Woolley Parsons, fascinating company. ASX code WOR. They are an infrastructure company, but they do infrastructure for the mining industry. So BHP Billiton doesn't do everything, right? They don't prospect, get the money, get the resources out of the ground on a ship to China. They do less than that. They don't develop the mines usually, because when you want to develop a mine, you want to get the iron ore or coal or whatever, zinc, copper, out of the ground and put it on a boat and send it to China. You need infrastructure. And BHP Billiton is not an infrastructure company, it's a mining company, that's what they're good at. So they outsource a lot of the infrastructure construction to Woolley Parsons or these sorts of companies. They build the roads, they develop the mine as well in terms of all the elevators, the shafts, the conveyor belt, all that stuff. Infrastructure companies like Woolley Parsons do that. It's a fascinating business actually, Woolley Parsons, but I think almost every business is fascinating, so it's not saying much. So what do we have here? So let's have a look at this composite valuation table. So first here, we've got the few PE ratios. We've got, as I showed you in lecture 6, there's not one PE ratio. You can look at quite a few different PE ratios. So first, you've got the historical PE ratio. Maybe you have an average over the, what do we have here, 9 years. You can say it's monthly basis from April 2003 to April 2012. You've got an average, you've got a standard deviation over that time period of 9 years on a monthly basis. You've got a high-low range, essentially, +1, -1 standard deviation. And then you've got the current or the latest PE ratio. And then what you have is this final row. This final one is essentially the choice you make on what final valuation multiple to use to multiply by earnings per share to get a valuation. It says NA, not available, not applicable. The reason why this team did this is actually me, this is not a team. This is the reason why I did that when I created this example was because this is a historical PE. As I showed you in class, historical PE, not the best, right? And I gave you the data for the historical PE as well in the file for the second assignment. There it is, the trailing PE. But analysts are not really interested in the historical PE. Historical PE is the actual price per share divided by the actual earnings per share. Analysts are more interested in the forward PE, which I gave you data for here. The current price per share divided by next year's earnings per share. But there's nothing stopping you from having a look. Right? You can always have a look at historically what the actual price divided by the actual earnings per share. So the actual, by that I mean what the company actually reported not some analyst predicted, or you guys in your case, in the case of JB Hi-Fi, you can always have a look what it is like. So for JB Hi-Fi, as you can see, you've got the data back all the way to 2004. The company hasn't really, the reason why you can go back, you can't, it's not like with beta analysis you shouldn't go back like 2 years or 5 years, anything beyond that. With beta you could as well, actually, a lot of you did, and that was good. But with JB Hi-Fi, the reason why I don't think it's too bad to go all the way back even to 2005 and 4 is because the company hasn't changed much. The business model is identical. The only thing that's changed is size. Right? The only thing that has changed about JB Hi-Fi is the size, the number of stores. That's it. The product, the marketplace, the customers, the target customers for JB Hi-Fi, how they do business, how they sell TVs and fridges and washing machines hasn't changed. So because the business model hasn't changed, when you're coming up with a historical reference point, so to speak, or these in this composite valuation table, this plus or minus 1 standard deviation, you can go back as much as you want, and you don't have to limit yourself to, like, let's say, all the last 5 years. If the business has changed, if you value a company that has changed a lot, you do have to limit yourself as an analyst. So if we talked about Wesfarmers, for example, I talked about that in the lecture, fascinating company. The company has changed over the years a lot. So if you were to do a high-low range, wanted to calculate the standard deviation or something like that, this range up here that I'm talking about, this April 03 to April 12 in this example, would be a lot shorter. It would be after the acquisition of Coles. Coles is a big company, right? And Wesfarmers bought it for a good price. I think 2007, right? Something like that. And so you would only go from 2007 to, if you wanted to, you wouldn't take all the history of Wesfarmers, which is very long. The company's been around for a long time. So that's why, and you should always report the range over which you calculate your any standard deviations or anything like that in a table like this. But what I'm trying to say here, for the historical PE, don't be afraid of saying NA or not applicable here. And the reason why I did that in this example is, again, historical PE, you can have a look, but it shouldn't be the primary PE ratio to use. If you had a look at JB Hi-Fi, it looks quite reasonable to me. Yeah, nothing too crazy, right? Looks normal. For this example that I have in the workshop, Woolley Parsons, as you can see, I've got both PEs in a chart, and you can do this as well. I encourage you to do this for your second assignment, is to do a plot of all these ratios. Do a plot of PE, both the historical and the 1 year forward PE ratio. As you can see for this example, Woolley Parsons, a PE of 50, not good. That's crazy. Yeah, PE of 50 is ridiculous. Right? So the reason why there's, as an analyst, when we're students here, but if I was an analyst, I would actually go and investigate why is it 50 and spend a lot of time in trying to explain why it goes up so much and does that make sense and that sort of thing. For Woolley Parsons, they did have, I think my workshop notes talk about that. There were abnormal items for Woolley Parsons. The company had a lot of write-offs. They changed their business model. They were up and down because of the mining boom, crashing and creating and then bursting. So it's a company that has a lot of volatility in its earnings. You won't see that sort of volatility with JB Hi-Fi. JB Hi-Fi, even through the financial crisis, so when household spending was down, they did okay. Company that has created a business that is not considered premium, in the sense that when there's a credit crisis or credit crunch, the first thing that goes is durables. Consumers stop buying durable products, washing machines, TVs, fridges, hi-fi. Well, we don't get hi-fis anymore, but you get the point. Apple products. But in Australia, JB Hi-Fi is not considered premium, a premium outlet. That's sort of Meijer, David Jones. They're considered sort of the premium, and Harvey Norman, the premium retailers. JB Hi-Fi is considered a discount retailer, and not like Aldi. Don't think of like Aldi. A discount retailer relative to its competition. And that's a good thing when something like a financial crisis hits, because people stop going to expensive places or places perceived to be more premium or expensive, like Meijer, like David Jones, like Harvey Norman, but they still need electronics to some degree. So that's why JB Hi-Fi still does okay even in an economic downturn, which is a good thing. You know, it's for an investor and for a company. It's nice to have a stock that, while it's cyclical, let's be clear, JB Hi-Fi is a cyclical stock. It is more defensive in nature than a Harvey Norman, right? So you might not get these abnormals in a PE ratio like you would for a company like Woolley Parsons, which is, wow, as cyclical as it gets, right? It is really a volatile company when it comes to earnings because it operates in a volatile industry. Mining is quite volatile, especially for small players. Woolley Parsons is not a large company. For BHP and Rio Tinto, they're fine. They're big businesses, billions and billions and billions of dollars of projects. Woolley Parsons is a small player, so their volatility is also explanation for these spikes, these peaks and troughs, is also because the company doesn't have a diversified business. They only have one product, and that's this infrastructure construction for the mining companies. Right. So what I'm trying to say is, go back to this table that I'm working on. Yep.
So for JB Hi-Fi, its beta is generally equal or similar to 1 or?
Yep, something close to that, yeah.
But why you say it's more defensive in terms of the other comparison?
Yep. Yeah. Yeah. So yeah, that's how the company does its business, but its beta should still be more than 1. If it's not more than 1, if you guys had 0.9, something like that in the first assignment, I didn't deduct any marks. If you had 0.6, 0.5, some of you did, I deducted marks for that because that makes no sense. 0.5, 0.6 is for utility companies, not for retailers. So it doesn't matter that the data gave you that. You had to filter the data, look for outliers, use more data, more than 2 years of weekly returns. So yeah, it's a good question. It might be one explanation why the beta is a little bit lower, but still it should be above 1 because it is a retailer. It's not when you run the test that I showed you, so I was happy with 0.9. So if your assignment says 0.9 or something like that, leave it like that, that's fine. Yeah. But yeah, beta is really for the industry. It's not really for the individual company. So that's why I would still expect the beta above 1, even though JB Hi-Fi is a little bit more defensive than something like Harvey Norman. Yeah. Any other questions? It's a good question. Yeah, why is the beta so low for JB Hi-Fi? I don't know. .9, close enough to 1, I suppose. But it should be, theoretically, it should be above 1. Practically, it's not, unless you did something silly like a beta of 0.5, 0.6. I didn't deduct any marks in the first assignment, and you don't need to correct it. Yeah. So that's why there's an NA here, because it's historical, it's backward looking. And for Woolley Parsons, it should be NA. Look at these spikes, that's huge. P of 50, really? No chance, right? With JB Hi-Fi, just looking at the data now, it seems more reasonable. Look, in the 20s, there's 140 that looks iffy. Everything else is okay. So you want to use the historical PE to get a price per share? Do it. Do it. You can for JB Hi-Fi. You don't have these crazy spikes like in this Woolley Parsons example. And most historical PEs look like this, by the way. They are not smooth. Yeah. Next in the table, this is the main one, the 1 year forward PE. You need this. This is required. So you have an average, again, a historical average over the last couple of years, over 10 years, 9 years, whatever you selected as a team. Standard deviation, plus or minus one standard deviation to get a range. You get the current or the latest PE ratio, which is in the file. Let's have a gaze. The latest PE ratio, forward PE ratio for JB Hi-Fi is that one, but that's not the one you use, obviously. Right? Like I said, you cannot use the PE ratio for your company to value the company. You need the average of the comparable companies without whatever that is. I assume that's Amazon, right? 83. Right? So don't make that mistake. Please, as a team, do not use the PE ratio of JB Hi-Fi to value the company. This average here should be the Compco average. What some teams do, and I don't like it, but I don't deduct any marks for that, is they have a forward PE that is JB Hi-Fi's or whatever company we're valuing in the course, and then underneath it they have the Compco PE as well, so they use both PEs to get a share price. I don't deduct any marks for that, but that's not appropriate. It's not an appropriate use of the PE. You cannot use the company's PE and the company's EPS to get a share price because you just get the current share price. That's all you get. So there's no valuation exercise. So this forward PE, if you have one in this table, should be the Compco, the comparable company average, or if you picked one company, you could have two PEs. One is equally weighted, one is value weighted. I've seen teams do that as well. You can do that. Sure, that doesn't bother me. That actually is what I would do as an analyst. I would have I have 4 comparable companies or 5. I would have an equally weighted PE ratio of those 5 companies here, and I can get the historical data for that as well, just an equally weighted average of the standard deviation so the standard deviation of the average and the one standard deviation up and down, and also value weighted based on the similarities of the business. Yep, makes sense. And I think in my example, which I have to change, I don't like that example. Company examples, let's have a look. So what I did for the PE, I had the average. So again, you have the latest, which is the companies, I assume. You don't use that. That's no good. Average of the comparable companies, that's what you want. No, that's the average of the company. That's not what you want. This is what you want. Yeah, the average of your comparable companies. You can have an average of the average, I assume. This is what that is. Yeah. Multiplied by the earnings per share to get a share price. So you can do this as well. It's just a meaningless number. Yeah. It's a meaningless number. It just gives you the current share price. If you use the JB Hi-Fi's PE times JB Hi-Fi's EPS. Yeah. Okay. And then the relative PE. Yes, you need a relative PE, like I told you in the example and in the lecture. You need to calculate relative PE like this. You know, you have your PE of your company divided by the PE of the market. So this is PE of the market or the index. The relative PE is the PE of your company scaled by some benchmark. You have I have 3 benchmarks in this class example. Equally weight them, you get, this is the relative PE, 0.993, and your last step is to convert the relative PE to an absolute PE to get back an absolute PE that you can multiply by the share price. Yeah, I think there's always one team each semester that gets, please don't be that team, by the way, that multiplies this relative PE by the EPS to get a share price. Not good. Not good. You get like $1 per share. Current share price for JB Hi-Fi is 20 something, right? Not good. Yeah. So please don't be that team. So remember that you have to convert the relative back to an absolute. So when you go back to my example here, you got the relative PE. It looks small. It is. Then standard deviation. You can do. Remember, you can calculate the relative PE historically. I gave you the data. This is time series as well. So you can calculate the relative P and do your standard, standard deviation plus or minus a range, stuff like that. And then you have a current, the latest relative PE that you've selected. And everything is in, see this is all relative PE. But remember, all these relative P's to get a share price have to be multiplied by the markets, the ASX 200 latest PE ratio. So you have to multiply it by either this number or this number. They're the same. The all odds are the ASX 200. The all ordinaries is 500 stocks, the top 500 stocks in Australia. And the ASX 200 is the top 200 stocks. The reason why that's almost the same number and always will be is because those other 300 stocks that are in this All Ordinaries index are tiny. They have no impact because all these indices are value weighted. So the larger you are as a company, the bigger influence you have on the index. The bottom 300 companies are tiny compared to the top 20. In Australia, we essentially have like 10 companies that are big. Right? The 2 mining companies, BHP, Rio, the 4 banks, Commonwealth Bank being the largest, second largest ANZ, third largest Westpac, fourth largest NAB. Then we have a large telecommunication company in Telstra. Then we've got, sort of Westfield, Wesfarmers, those sorts of companies which are quite large. We have a pharmaceutical company called CSL, which is large. And that's basically it. All the other companies are mid-size or small. So that's why there's not that much difference between ASX 200 and ASX All Ords. And if you, and plus they're 99.9% correlated. So it's 99 point something. I think it's 0.7 or 0.8. It's not 0.9, but it's highly correlated, highly correlated. All right. So it doesn't matter which one you choose is what I'm trying to say. You pick whatever. It doesn't make a difference. And remember to convert the relative P in order to get a share price. Then you've got, what do we got? The EVM, the Comco average. There is no historical, there's no standard deviation here. That's a mistake in my example. There should be stuff. You can actually get a time series and therefore you can calculate a standard deviation. I'll show you how. And then a takeover valuation, $32. Yeah, there's no historical time series there. And then your assignment number 1. You need your assignment number 1 share price in this composite valuation table, please, which in this example is $31. And then the next, so here you got all your valuations for your company. If you want to do an average of an average, you can, all these averages, and here it is. And this, you can compare, this is the current share price when you submit your second assignment, and you can do a comparison percentage difference between each of the valuations that you get from the different methods, compare that to the current share price. And if you want, you can. Most analysts do this, and I think this makes sense, is there's a weighting. Instead of this being an equally weighted average, so an average of an average, arithmetic average, do a weighted average based on the appropriateness of each of those methods for your company. Analysts do this because if you just do an average of an average, you're assuming each method is the same in terms of its validity, and that's incorrect. The one that should have most weight is DCF. It's the most complicated and the most detailed. So that's why in my example it has 40% weighting. You take over valuation. I did it, but I gave it a 0 because it's just unrealistic. I mentioned that in the lecture as well. You can still do a takeover valuation, but if you do one and there's no takeover announcement, it's kind of meaningless. So that's why there's a 0 weight assigned to it. And all the ratios that are relevant, I did a 15% weighting for each of those. It's probably too high. I would so for JB Hi-Fi, what the weighting should be, it's up to you, but the majority should go to DCF. There should be at least sort of 40-50% should go towards discounted cash flows, and the other ones I leave up to you. Yeah, price to book as well is not in this table, so that's another one that you should have. Cash flow multiple, not in this table, something you should consider. Dividend yield should not be in this table because it's just a percentage. It will not give you a share price, so it shouldn't be in this table. But you have plenty of things to play with, right, with the ratios. So you'll have quite a few. You can have the historical PE, you can have the forward PE, Comco average. You should have the relative PE. You should have the EVM. There's 2 EVMs. One is EVM. I'll show you that one, how you can calculate the historical, and then just the final average EVM. So you can have a few EVMs there. And You can also have another EVM that is equally weighted, equally weighted of the comparable companies and a value weighted of your comparable companies. Same thing with PE. You can have a PE where your 4 or 5 companies, you should do 4. 3 is, I got an email yesterday, is 3 enough? It says that 3 at the very minimum. Please do 4 if you want a good mark. If you're happy with a reasonable mark, then 3 is enough, but my recommendation is to do 4. You can do equally weighted average of the PE, or you can do a value weighted average of the PE. And don't play games with the value, with the weights. I can see that when I mark the assignment, and I punish that. So if you're trying to get weights to reverse engineer a PE that you like, I take marks off for that. That's fraudulent valuation. So if you want to do weightings, you can. The weighting should be based on the similarities of the business, and the size is also used as a proxy for sort of a weight. So similarity of business, the size you can use to, it's subjective, but to back out some kind of a weighting. Yeah. So this table should be quite populated in your second assignment. And if you give me, and down here it says some explanation, usually under these tables in analyst reports, you'll get a small explanation of what the comparable companies are. If you used weights, what were the weights? If you used equally weighted, you don't need to explain that. But if you use weights, you should explain what the weights are and why did you choose them. So there's this section at the very bottom of the table gives you an opportunity to explain what you did to come up with these numbers. So please do that in your assignment. Okay, let me go through the actual notes. So I wanted to spend time on the composite valuation because that's something I didn't have time to talk about in lecture 6, and that's something I will be looking for in assignment number 2. So a summary table or some kind of a table, composite valuation table that looks like this is something that you need to do. And it's not hard, but you still have to bring it all together somehow, all these different valuation methods. Next, so in the assignment, like I said, PE, EVM are the most important. For PE, of course, the most difficult part about the PE analysis is not multiplying numbers. That's easy. The most difficult is to calculate the diluted normalized earnings per share. That's that's going to take up some time. And also the other part of the assignment that's going to take up a lot of your time is the EVM table. So in the lecture notes, what I'm referring to, in the lecture notes, I showed you a few examples. This is the diluted normalized earnings per share table. You need to do that for JB Hi-Fi. And also a EVM table that looks something like this for JB Hi-Fi and the comparable companies. Right? So you'll have JB Hi-Fi here as your first company and your 4 comparables. If you do 3, that's okay. But you won't get the additional marks in the sense that when I go to mark it down here, it's is additional marks for additional work, sort of. So if you did 4 or 5, that's where I reward you when I mark your assignment. If 3 is fine, if you do 3, no mistakes, everything's great, you still can get a high distinction. But analysts do as many as they can, and in this assignment, 4 to me seems, for JB Hi-Fi, you have the data. There's no excuse for not doing more than 3. And by the way, I'll be nice to you. If I give you data for like 10 companies, right, that I could just find, I spent half a day, less than 3 hours looking for. I'm not lazy, but I'm not that hardworking, right? So I gave you data for, what do we got here? So we've got 12 companies minus JB Hi-Fi 11. If you want a company that you've identified outside this list that you want this data for, I can download it for you. Just send me an email. Tell me what company it is. Make sure it's a public company because I cannot get data for private companies, obviously, that it's listed, and send me its code. So the code, and of course it can be a foreign company, it doesn't have to be Australian. So the code would be dependent on the exchange, but in Australia it's JB Hi-Fi JBH, Harvey Norman's HVN, Myers MYR, so on and so forth. But as you can see, the @ sign here means it's a NASDAQ stock. U means it's an NYSE, a New York Stock Exchange stock. J, I assume, is the Japanese Nikkei, so the Japanese exchange. I thought there was a Korean company here somewhere, but it doesn't matter. It's they can be international companies, European as well, of course. The currency does not matter with ratios, it cancels out. So if your team wants more data for companies that are not on this list, I can send it to you. But send me the email soon, right? Don't wait 2 days before the due date, because that annoys me. Yeah. So I can give you data for other companies as well, because what I have is, what I'll do is I'll just change this list to whatever list you want, and I'll give you the same data: price, unadjusted price, PE ratio. This is historical, price to book, forward PE ratio, forward earnings per share, forward EBITDA, forward EBIT, market value, debt minus cash, so net debt, and this is the index PE ratio and the PE ratio of whatever that is. That's the index I found. Yeah, that's the retail index. Right? I can get you more data. Yeah. Okay, so let's go through these things. So first, the absolute PE. Right? Okay, so series are provided to you, right? Both the historical and the forward in the file. You may need to manipulate in the sense that if there's a P of 50, or let's be specific, Amazon, P of 100 and whatever, or P of 80, no, ignore. Do not use that in any way, shape, or form, please. So when you get the raw data, just like with beta, you got the beta data, you did your test, and you got a beta of 0.5. That makes no sense. You had to manipulate. So same with the PE ratio. You can't just accept it. There has to be a smell test. All analysts have to use a smell test when a PE ratio of 89 does not make sense. Right? So do not use that. One way you can sort of see if things make sense or not is to generate a chart. It's not hard in Excel. The time series plot is very easy. It's not very difficult for you to select your PE ratio, whatever it is for your company, and then insert a chart. It's not that hard. The NAs are because I selected the NAs very wisely. So let's have a look. Right? And not just for JB Hi-Fi, for the comparable companies as well, right? It's not complicated to do charts, look at the history, both the historical and the forward PE ratio, and have a look how they've traveled. As you can see, there's some consistency here, quite all the way through. And this is 2008. That was distorted because of the financial crisis, but it's been quite sort of stable since the end of the financial crisis. So that's good. It means you can sort of take your historical data over the last 10 years if you want to calculate standard deviation, the usual. Yeah. So analyze the distribution. Very easy just to calculate average, high-low range, plus or minus 1 standard deviation, any trend. Ignore any cycles like the financial crisis. You saw a huge increase before 06, 07, great time to be an investor. But then 08, boom, ouch. So ignore that. Remember, ratios are in perpetuity, so they cannot deal with some spikes in the market. Always apply, as always, apply judgment. There is subjectivity with any analysis as an analyst, but please don't give me garbage. Don't give me a beta of 0.5 or a PE ratio of 89. That makes no sense. You have to look at your company in terms of the PE and also a chart, both historical and forward, of course, and your comparable companies. Right? Think about the relevance of the history to the valuation today. Has the company changed? JB Hi-Fi hasn't, so that's easy. Has the company growth profile changed? Not really. They just grown in size. Even if you can argue, oh, they bought Good Guys. Well, Good Guys has the same growth profile as JB Hi-Fi stores. If anything, their growth profile is less, which is why, as I said in class, buying so many stores is a little bit on the risky side, right? But I don't work at JB Hi-Fi. I don't make those decisions. That's just my opinion. Historical averages are easy to obtain, but can cause flawed valuations. So be careful of just using an average for everything. You always have to look at how you get the average. And one way to do that is to do those charts. right? You should definitely do, it's very easy, like I showed you in Excel, to do some charts of, of historical and forward PE, chart of a relative PE, a chart of an EVM. I'll show you how to get the historical EVM in a sec. Oh, by the way, these are the templates that I used in the lecture example. Right, so this is the template for the diluted normalized earnings per share, more of a formal blank template if you want to have a look, but that's what this example uses, that template, and you have to modify it depending on what company you're valuing, and if they have some kind of something you need to normalize for, or some kind of issues, share issues, I mean. Everybody has issues. And same thing with the EVM. This is the EVM table that I used in the lecture, the blank template, and this is the one in my example here. Right? So that's why they're included in these workshop notes. They're just those tables without any data, and you need to populate that. Okay. So let's go back here. So examine your company, yes, decide on an appropriate is subjective, that's true, but a final PE that you need to use to value your company. Right? For each of those methods, for the relative, for the historical, for the absolute, so for the forward absolute, it's you have to decide on a final PE. Don't just say, oh, I don't know, I've got too many PEs. No, you have to choose one, right? Yeah. Relative PE, as I said, is the PE of JB Hi-Fi in your case divided by PE of the market or the industry. So I gave you data for two industry indices that you can use, and then you need that final market PE to convert a relative back to an absolute, and that's where this time series comes through. This one or this one, choose one or the other, it's up to you. But these are the two industry ones that I want you to use. So in this example in the lecture, I think I had three. But you only have two. So 50-50 weighting, you can do that between those two. And then your final conversion is from that relative P back to an absolute by using the latest P ratio of the ASX 200, which was 17.72, or if you choose the all odds, I don't care, 17.84. And again, you should generate charts, history, range, average, mean, median, mode, high, low, range, whatever you like, right? Same as PE. Okay, this is important. EVM. So the EVM, in my example, traditionally, you think you can only calculate one EVM, right, using the latest data. That's true, you can. And that's how analysts usually do it. But databases these days give us so much data that we can actually calculate a historical EVM. Unfortunately, what the databases do not give us is non-operating assets, right? Which is annoying, right? So if a company has a lot of non-operating assets, we cannot use, it's hard to calculate a historical EVM. But analysts still do it, is what I'm trying to tell you. They still do it. They still ignore the non-operating assets when only for the historical generation of a historical series of an EVM. And for the latest one, for a table like this, of course, they do not ignore it. So don't ignore non-operating assets for your company and for the comparable companies. But for historical purposes, you can. In these notes here, I call it a rough. So data has been provided to permit you to generate a history of a rough one-year EVM without these non-operating assets. What you can do is, to calculate a historical EVM, take the market value of equity, here it is here, market value of equity for your company and the comparable companies you've selected, market value of equity right there, plus the debt, and that means net debt, data's right there for your company and the comparable companies, times the right units, make sure everything's in the right units. I think debt is in thousands and market values in millions. It's just the way DataStream gives me the data, it's annoying. Divided by the EBITDA for the next year. That data is here, right here, for your companies and all the comparable companies as well. Using that, you can generate EVM historically without the non-operating assets. And that historical generation, a time series, then allows you to do your standard mean, median, mode, high-low range descriptive statistics, they're called. Yeah. So you should do that. Do that for your assignment so that in your composite valuation table, you can have a standard deviation here. And you can have a high-low range for the EVM as well. That's the benefit of that. And I'm happy for you to just to ignore only for the historical time series for the purposes of generating a standard deviation. I'm happy for you to ignore the non-operating assets for JB Hi-Fi and all the comparable companies. So in my lecture example, this team that I took this example from did a high-low range just by using plus or minus 5%. That's stupid. It's arbitrary. It's not sophisticated in any way, so I wouldn't do it if I was you. So don't just do that. Don't do plus or minus 5%. That's silly. Doesn't mean anything. Yeah. So going back here for 10 more minutes, let's have a look. What else can I tell you? So you don't have non-operating assets for this historical EVM, for this time series generation, or the non-equity claims. So errors are probable. With JB Hi-Fi, the non-equity claims, the leases will be a big one. They're not in net debt, the JB Hi-Fi. But again, I'm happy for you to ignore that. It's just for the standard deviation purposes. It's just too much to ask you. You have 3 other classes to worry about to get the leases, capitalized each year. The alternative is you look up the non-cancelable leases each year. Again, I don't want to ask you to do that, so I won't be looking for that. Yeah. But the data may suffice for a rough guide to see how this EVM has moved historically and also allow you to calculate the standard deviation that you need for a high-low range. Non-operating assets, non-equity claims should be considered for the finalists for that table that I showed you in class, and I showed you the template for. Of course, you cannot ignore any non-operating assets or non-equity claims there. For JB Hi-Fi, you have to check for the other comparable companies as well. The non-equity claim, the leases are large, over $700 million. They're not small, so you cannot ignore them anyway. I would deduct marks for that. And for those for your comparable companies, take everything from the annual statements. You don't need to forecast anything, right? Is what I'm trying to say. Because in the table that you need to use to calculate this EVM for all these items for your comparable companies, just take them from the balance sheet or the notes to the balance sheet in each of those reports. And if you chose a Japanese company and the Japanese company doesn't provide the reports in English, I cannot help you. I don't speak Japanese. That always comes up. Some team, every year, some team chooses like a Korean company or something like that. And if you have a Korean person on the team, that's fine. But if you don't, I don't speak Korean, so I cannot help you. Yeah. So that's one. Just be on the lookout for that. Yeah. One company I remember last year, or 2 years ago, chose a French company. And yeah, I don't speak that language, yeah, so I cannot help you. Yeah, not good. But big companies produce statements in English as well. Quite common for a company, a large Japanese company. I don't know if Yamada does. That's the company I gave you data for. I don't know if they give data in annual statements in English as well, but large companies do. Mitsubishi, Sumitomo, these companies, they would. Right? These are huge businesses, right? Right. So take these numbers for the comparable companies from the annual statements, and same with any non-operating assets. Just take the book value, please. You don't need to do any forecasting or estimation there, like I said in the lecture. Book value for these comparable companies is fine. Again, start by generating charts for the EVM. Once you have this rough method, you can actually plot the EVM as well. Think about the relevance to the history, to the valuation today. If the company has changed or the comparable companies have changed, do the ratios show that? And then decide on a final EVM to use in your valuation. Right? For the diluted normalized EPS, like I said, we want 2 years forecasted. So we want 2008, the actual year, and then 2 years forecasted. In my example, I think that's what it is. It's 3 years. Yeah, it's 3 years, so 1 actual and 2 forecasted. F means forecast, A means actual. Most analysts actually have 4 years, and if you want some additional mark, I would do it for 2017. Despite the Good Guys acquisition, there's a lot of adjustments that you'll need to make, but it is worth maybe half or one additional mark in the assignment. So 2017-18 actual, and then 2019-2020 forward. For all the options on issue, remember, include all shares that would be issued for in-the-money options in the denominator of the earnings per share, and add in 2019, and add the proceeds the firm would receive from the option exercise as the firm is short in the calls in the numerator after multiplying it by the dollar value after multiplying the dollar value of this exercise income